Ladies and gentlemen, good day and welcome to the Q3FY22 earnings conference call of Tarsons Products hosted by Ambit Capital Services. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anshuman Gupta. Thank you, and over to you, sir.
Hi, hello everybody, moderator, and good morning everyone. On behalf of Ambit Capital Services, I welcome you all for Tarsons Products' first ever earnings call since listing. Tarsons Products has already announced 9-month FY22 and Q3 FY22 financial results yesterday. Today, from the senior management, we have Mr. Sanjeev Sehgal, Chairman and Managing Director, Mr. Rohan Sehgal, Full-Time Director, Mr. Santosh Agarwal, Chief Financial Officer. Congrats to all of you for a very good IPO. Now, I'll hand over to Rohan. Thanks.
Good morning and a very warm welcome to everyone present on the call. First and foremost, I hope that you and your family members are safe during these unprecedented times. Along with me, I have Mr. Sanjeev Sehgal, the Chairman Managing Director, and Mr. Santosh Agarwal, the Chief Financial Officer for Tarsons Products Limited and SGA, our Investor Relation Advisors. To begin with, I would like to thank and congratulate all our stakeholders, investment bankers, and business partners for helping us achieve a milestone of getting listed on the Indian stock exchanges. We are delighted to see such a strong response for our IPO. Since this is our maiden earnings call, I would like to take you through Tarsons Products Limited, its journey so far, broad industry update on plastic labware and strategies going forward, followed by operational and financial highlights of the quarter and 9 months ended FY22. Post that, we will open the floor for questions and answers. We have also uploaded our latest investor presentation on the stock exchanges, and I hope everybody has a chance to go through the same. Tarsons Products was incorporated in the year 1983 and now is one of the leading Indian supplier of labware products engaged in the designing, development, manufacturing, and marketing of consumables, reusables, and other labware products. With more than 3.5 decades of experience in manufacturing of trusted, high-quality plastic labware products, we supply our products to industries across research organizations, academia institutes, pharmaceutical companies, CROs, diagnostic companies, and hospitals. Today, we are one of the leading Indian supplier of life science sector with a strong brand recognition and high-quality diversified products across varied customer segments and end-user industry. We have a diversified product portfolio with more than 1,700 SKUs across 300 categories, including consumables, reusables, and benchtop equipment. Our consumable categories include major product lines such as centrifuge ware, cryogenic ware, liquid handling, PCR consumables, and so on. Our reusable categories include bottles, carboys, beakers, measuring cylinders, and various kinds of benchtop racks. We also make benchtop instrumentation such as vortex shakers, centrifuges, pipeters, and so on. We currently operate through 5 manufacturing facilities located in West Bengal. A wide array of products are manufactured across these facilities, giving us a competitive advantage in terms of technology, which we have accomplished through our years of experience in the field of manufacturing plastic laboratory products. We believe that by focusing on stringent quality standards across all manufacturing processes, we have been able to provide a reliable, efficient, and cost-efficient product line to our diversified end-user industry. At our facilities, we continue to invest in automation to reduce human error and improve throughput. We are working on expanding our manufacturing capacities for both existing and new products in a phased manner through construction of a new manufacturing facility in Panchla, West Bengal. The project is on track and we target to commission the new facility by the middle of 2023. We are also planning to develop a new fulfillment center in Amta, West Bengal to coordinate and expand our warehouse operations. At the same location, we also aim to do backward integration in the manufacturing process by building an in-house sterilization center for captive consumption. We have recently completed the land acquisition measuring approximately 6 acres for the facility in Amta, and the target to complete this project will also be the middle of 2023. Our products are distributed to end users on a pan-India basis by our authorized distributors. We have long-standing relationships with our end customers and distributors, which we have accomplished by an on-the-ground sales and marketing team. As on 31st December 2021, we have 150 active distributors spread across the country, supplying to various end user industries. High-grade quality products, diversified product offerings alongside the trust and the brand name developed over the years for Tarsons has helped us create a strong foothold in the exports and the international market as well. Our share of revenues from exports stood at 41% in Q3 FY22 and 33% in the 9-month FY22. We cater the demand of export market through branded as well as OEM sales, which we supply our products to more than 40 countries through a network of distributors and are very optimistic of huge opportunity lying ahead of us in this segment. As an organization, we are constantly striving to improve our environmental, social, and governance parameters. Our products are manufactured using medical grade plastic, thus designed to withstand critical use. We work under clean room conditions, which eliminates all chances of contamination. Productivity optimization will be done through higher use of automation. Company directly donates to various hospitals as a part of its CSR initiatives. We regularly review and update our policies for change requirements and have whistleblower policies in place. Our key strategies going forward will be to expand our product portfolio, focus on branding and promotion, manufacture new products in the cell culture and the robotic handled consumables, leverage the advantage of Make in India and grow our domestic sales as well as our international business through exports, enhancing our manufacturing capacities to leverage growth. We will be expanding our manufacturing capacities in various popular product categories. We recently acquired 5 acres of land to develop a new manufacturing facility in Panchla, West Bengal, and to expand and enter into new product segments comprising of cell culture, serological pipettes and others. Increasing presence in overseas markets, we plan to grow our international business to more than 120 countries in the next 7 to 10 years by a twofold approach of both branded product as well as OEM products. Also, we plan to enhance our operational efficiencies by using higher automation and higher throughput, leading to operating leverage play. Going forward, I would also like to reiterate that with multiple growth avenues for the future, like large addressable domestic market with continuous addition in product categories and addition of wallet share of the customers, huge opportunity in the export market with OEM as well as branded products, increasing scale and capabilities with in-house manufacturing and R&D, trust and reliability for our products with gaining acceptability across the domestic and international markets. We believe there is a huge runway for growth for your company, and we are prepared to leverage this opportunity with expertise and experience we have developed over the years. Let me hand over the call to Mr. Santosh Agarwal, our CFO, for operational and financial highlights for the quarter and 9 months ended FY22.
Good morning, everyone, and a very warm welcome to all our maiden earnings call. We have uploaded our latest investment presentation on the stock exchange for our Q3 and 9-month FY22 results. I hope everybody had an opportunity to go through the same. We are delighted to share that we have surpassed our FY21 profit in just 9 months FY22 numbers. On the revenue front, we would like to discuss revenue from operations for Q3 FY22 stood at 71 crore rupees as compared to 60 crore rupees in Q3 FY21, a growth of 17.3% on YOY basis. The sales growth was driven by higher demand across end user industry and exports. Revenue from operations for 9 months FY22 stood at 216 crore as compared to 161 crore in 9 months FY21, a growth of 34%. Revenue split between domestic and export stood at 59% to 41% in Q3 FY22 and 67% to 33% for 9 months FY22. Our export revenue for 9 months FY22 grew by 42% approx to 71.4 crore rupees in 9 months FY22 and 54% in Q3 FY22. At gross profit level, gross profit margin for 9 months FY22 stood at 79.7% as compared to 71.7%, a jump of 800 basis points on YOY basis. GP margin for Q3 FY22 stood at 77.9% compared to 76.5% in Q3 FY21, an increase of approx 150 basis points and down by 120 basis points on QOQ basis. Dip in gross margin on quarter-to-quarter basis is majorly due to change in product mix. Since we manufacture more than 1700 SKUs across 300 product categories, however, GP margin on quarter-to-quarter basis might vary and a more representative figure to be looked at is on annualized basis. At the EBITDA level, EBITDA for Q3 FY22 stood at 33 crore as against 31 crore, a YOY growth of 8%. EBITDA margin for Q3 FY22 was down by 400 basis points on account of increase in employee expenses, IP expenses, and more consumption of packing materials due to change in product mix, as highlighted above, which might taper off in the coming quarter. For 9 months FY22, EBITDA was 108 crore as compared to 69 crore in 9 months FY21, a significant growth of 58%. EBITDA margin for 9 months FY22 stood at 50% as compared to 42.5% in 9 months FY21, representing a growth of 770 approx basis points on a YOY basis. At a PAT level, PAT for Q3 FY22 stood at 21.5 crore as compared to 21 crore rupees in Q3 FY21, a growth of 2%. PAT for 9 months FY22 stood at 71 crore as compared to 45 crore in 9 months FY21, a significant jump of 57%. PAT margin for 9 months FY22 stood at 33%, a growth of 500 approx basis points as compared to same period last year. On utilization of proceeds from IPO, we have repaid the debt up to the tune of 78.5 crore, and currently we are a net debt-free company, which will enhance our profitability. Also, the construction of new manufacturing facility in Panchla, West Bengal is on track, and we target to commission the same by middle of 2023. Lastly, the demand scenario going forward looks robust, and we are optimistic of sustaining the growth trajectory with higher profitability on the back of operational efficiencies and scale. With this, I would like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead. Mr. Praveen Sahai, please go ahead with the question. Your line is unmuted. Mr. Praveen Sahai, may we request you to unmute yourself if muted from your handset? As there is no response from the participant, we'll move to the next question, which is from the line of Rishabh Parekh from Sunidhi Securities. Please go ahead.
Hi, Rohan and team. Congratulations on a very robust set of 9-month financials, and thank you for the detailed investor presentation. I had a few questions. Firstly, regarding the 22 performance, what we observe is there is no growth in the domestic market in Q3 versus the corresponding quarter last year. So just wanted to understand if what was going on there. Secondly, you all mentioned that there was a one-off in the margin, so if you all can elaborate on what the quantum was. And yeah, I'll ask my other questions after this.
Sure. Thank you. So if you see our numbers on Q3 FY22, 41% of our revenue has come from the international business. But if you see our 9-month revenue in FY22, it is in the 33% level, which is indicative of our company, which is at about two-thirds of domestic revenue and one-third of international revenue. Now, since our capacities are constrained and we are expanding on newer capacities, the international business revenue is not very linear this year, and it is clumped in parts and portions because we are unable to get the container availability and the vessel availability, which is an issue with all across the country and all over the world. So you will see a higher proportion of revenue which is coming out of international business because of better availability of containers in this period as compared to Q1 and Q2. So if you see our proportion of revenue changing, it changes from 75-25 in Q1 to about 63, 64, 36 in Q2 to about 59, 41. But on an overall 9-month basis, if you see, it stays at about 67, 33, which is indicative of our company over the last 2 or 3 years. And since we can only, because of restricted capacities, we cannot, we have back orders in both international and domestic markets. We can only cater a certain market at a certain point, and we cannot cater everybody. Hence, we would have not had any back orders at this point of time, and hence you see a little dip in the domestic revenues and a little increase in the international revenues.
So this is purely on account of capacity constraint that this was the case, right?
It's purely on the account of capacity constraint, as well as, more importantly, on container and vessel availability constraint. We are unable to ship out containers at the right time, and if you see that there are clumped sales in international business, international sales are not moving more linearly or more, every month there could be some really high peak months and some low months. It is all reliant on the container availability and not on the actual international customer demand.
Understood. And on the expenses front, you all mentioned some one-off items, if you can just quantify.
Sure. So we have, employee expenses which have increased slightly. The reason for that is we are investing, a few quarters earlier, which we need to do as we are growing into our next phase of growth, which is a pretty aggressive capacity expansion, as well as new product lines. We need to build people and teams for projects, as well as build R&D capabilities. So these employee costs will start wearing off over the next few quarters as the revenues start coming in. We need to invest a little bit ahead of time in employee costs. In packaging, we see a certain increase in the packaging costs because of dramatic increase in the cost of paper, which is again a very known thing all across the country. We believe that in the next financial year, we would have certain price adjustments which would take care of these price increases, as well as there is about 1 to 1.1 crore one-time expense of IPO, which was the IPO marketing expenses. That would be Q3, yes.
Okay. So our steady state other expenses run rate would be about 13 crores going forward as well.
Approximately, yeah, similar to what we have seen in the other quarters, yeah.
Okay. And my second question, right, was on our new product basket that we propose to introduce once our new manufacturing capacity is on stream. So going through your presentation, the Indian plastic labware market is about 12-20 crores, out of which about 500 odd crores is PCR and cell culture. So is my understanding correct that we're not participating in about 45% of the market right now? So
yes, I believe that we are not participating in about 35 to 40% of the market, as over the last 5 to 6 months we have launched various lines of PCR products, and we continue to do so towards the end of this financial year. We believe with the launch of the complete range of cell culture and further product categories, which are ancillary categories in cell culture, we would be catering to the entire market segment.
And what could be the competitive intensity in the new products that we would launch, and who would be our main competitors, and would we be competing mainly on price or faster delivery or better quality?
Our competitive advantages would remain similar to what it is currently. Current product lines offering high quality, reliable products with a very, very strong and trusted brand, giving quick deliveries to our customers in India and across the globe, and a brand and a product line which they can trust. So the value proposition would be similar for the new product lines as compared to what our current product lines are. So competitive-wise, I do not see in the competitive landscape, I do not see much of a change.
And who would be our main competitors in these PCR?
Global multinational players, because we would be the first manufacturer from India to enter into these product categories, the first homegrown made in India manufacturer. So mainly multinational companies from across the world.
And would we be cheaper than them? And would they be manufacturing these products in India, or would they mainly be importing?
These products are imported as of today, and yes, we would have cost advantages producing the same in India, and we would be passing on these benefits to the final customer.
Understood. And my last question, right, was on our sterilization facility. What kind of, what was the thought process of making it in-house, and what kind of, since we're backward integrating, what kind of margin improvements can we expect once this comes on stream?
Approximately, the cost of sterilization today for us is about 3 crore per annum, and moving forward, I think over the next 5-7 years, that could grow by about 5 to 6 times the cost of sterilization. Having sterilization in-house could probably give us an advantage of about 100 to 120 basis, points on our EBITDA margin. But we are looking at sterilization not so much on a margin perspective, although it would improve our margins. But we are looking at it more as developing a capability in-house, because 100% of the future capex, what we have planned and what is ongoing today, is reliant on sterilization. So we need to create a world-class sterilization center with world-class laboratories to cater to our growing needs of sterile products.
Understood. I'm sorry, my last question was on exports, right? Would the export margins be similar to our domestic margins, and especially in the export ODM business?
So our export margins are similar in the ODM and branded business. On a gross level, export margins are slightly lower, to the tune of 5 to 7% to domestic margins. That is because it does not take into account importer margins in other countries, as well as larger costs of freight, as well as custom duties and clearances in respective countries. But on a net level, it is pretty much similar or identical to domestic margins, because the overhead costs are very, very negligible as compared to overhead costs in domestic business.
Got it. Thank you. Thank you very much.
Thanks.
Thank you. The next question is from the line of Pankaj Shah from Dinoro Wealth. Please go ahead.
Hello. Good morning, everyone. So the first question is on the revenue. I want to understand how much revenue is contributed by COVID-related products. And as you said that we have some capacity constraint as of now. So how does FY23 look like? So as the COVID subsides, the revenue will go away, and we don't have capacity in place. So how do you see FY23 till the new facilities or the new capex come in place, say by Q1 of FY24?
Sure. Thank you. Good morning. So I feel that our revenues today, at peak or during peak COVID, we estimated that about a third or probably 30% of our revenue came from COVID. The current wave and the current signals over the last 5 to 6 months, COVID revenues have been wearing out, although the cases have been high, but it is not the same as the first and second lockdowns. So today we estimate that our current COVID revenues already are in the mid to high single digits and continuously wearing out, and more the regular product sales taking over. So we are in a constant process of increasing capacities in both, currently in this financial year as well as next financial year. So it is a continuous process and not a one-time process which will show at the beginning of FY or the middle of FY24. So we are very confident of a strong and robust growth from our existing as well as new product lines without COVID revenue in this Q4 of this year, FY22, as well as the entire FY23.
Okay. And can you brief us on the entire capex program which you were talking about during the IPO? Say, I think the program was about 350 to 400 crores, including Panchla, the fulfillment center, and the existing facilities. The timeline, the capacity, and how quickly can we ramp up these new capacities coming in place?
Sure. So yes, as you are right, it is about 400 crores of capex plan. We are 190 crores has already been paid, and a lot of capex. We have started receiving a lot of our increased capacities, as we have made a payment of 190 crores already. We have 60 odd crores earmarked from our IPO proceeds, which will be paid in a phased out manner for the construction of our facility in Panchla. And the remainder of about 150 to 160 crores would be ably paid by our internal cash accruals over the next 18-month period.
Okay. And how quickly can we ramp up these capacities? As in, do we have the, as you said, the orders are there. So once the facility comes up, we can quickly utilize it, right?
Absolutely. At least for the portion of our existing capacity expansions, the ramp up will be much quicker. In terms of the newer products, there would of course be a teething period in which we launch the products and get product and slowly ramp our products to reach full capacity.
Okay. Okay. And what would be our gross and net asset turnover?
I believe that the gross and the net asset turnover should be identical or maybe slightly better to our current net asset turnovers. In the gross asset turnover, maybe we might expect a slight dip from our current gross asset turns. That is because of the higher cost of infrastructure and construction, what we face in 2022, 23 and 21 as compared to few years ago.
So, if I'm not wrong, our current gross PP is at, say, 1.7 for FY21. You expect it to reduce because, yeah, okay, that's the net. So, we expect it to...
turnover, gross would be lower.
Yeah, so gross as per the old accounting standard comes at, say, 0.74, 0.75.
Right. So we believe that for our equipment, plant and machinery, the asset turns would be equivalent or better because we're getting into better value-added products. But things which are out of our control, which is construction, land, infrastructure, the costs, as you know, of steel, TMT, cement are at an all-time high. So that play into certain, more expensive investments, and hence the asset turn on the construction infrastructure part might be a little lower.
Right. In the last question, actually more of clarification. So in the IPO, in the DRHP, you mentioned that there was a serological peptide manufacturing facility which was temporarily suspended. So what is the status there? And again, the status on the Petri dish automated system. That project was also suspended due to COVID.
Right. So the first line was a serological pipette line. It was not suspended, but it was more of work in progress, because there were certain technologies which we were trying to develop in-house in order to perfect the product, and hence it was a capital work in progress. The Petri dish line is a proven, tried and tested line. It had reached us, but due to COVID restrictions, we need the assistance of certain engineers, automation engineers from Europe to fly down to India to help set up a facility. This is a starting facility, when you start a new line of automation, you always need this, and because of travel restrictions and COVID travel restrictions, we were a little delayed in starting up the same. However, the engineers have visited us, and the facility is on the verge of getting started, the Petri dish facility.
Okay, great. And the Petri dish?
This is about the Petri dish, which I just told you. For the serological pipette, as I said, that we are in the midst of acquiring certain technologies to perfect our product, and we are very, very confident of starting serological pipettes in Q1 of FY22.
Okay, great. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Saket Mehrotra from Tusk Investments. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah. So Rohan, one quick question on the numbers. What I can see is for the last 3 quarters, our EBITDA margins have actually been coming down. In the H1 business update that you guys had disclosed, you guys had talked about the fact that this margin has gone from 46 to 52. Whereas what I'm seeing is for the last 3 quarters, our EBITDA margins has been consistently declining. So any reason for this? Is there some one-offs, or how do we see this going forward on a sustainable basis?
Sure. I think, firstly, on a sustainable basis, we expect expanded EBITDA margins from what we achieved in FY21. So to be on a on a higher level to FY21 EBITDA margins, there have been cost and inflationary pressures in terms of packaging material, in terms of transportation and other things. Being a very strong brand with delivering trust is what our slogan says. We generally do not change prices mid-year unless there is an absolute necessity or need, or if margins have gone completely haywire. So we generally change or reflect into newer prices on an annualized basis by contracts and the customers domestically as well as internationally. So we will look into what our pricing is and where we can recover some of these margins on the new financial year, which is in FY23. But I believe that the lowering of the EBITDA margins is passed down from it's more or less a fixed cost business. So the more we sell, the more margins we make. It's the costs are almost fixed. We do not hire more people when our sales are more, reduce people when our sales are less. On the gross margin, area, you would see certain fluctuation. That is only because, as I explained earlier, we came from 75%, 25% in Q1 F1 to 67-33 in Q2 FY22 to 59-41. So most of our international business has been clumped into Q3, which, if ideally divided between Q1 and Q2, would have showed more, reasonable margins and not so much of a spike.
Okay. So which brings me to my second question, right? So is there some sort of saliency when it comes to, let's say, the sales that come in? Because if I see the last 3 quarters, and between September and December, we've seen a 7% decline in sales. So is a bulk of our revenues, recognized towards Q4 in a financial year? Because we don't have the data for March 21. So just want to get a sense with respect to how, let's say, the saliency of our sales are when we compare it across 4 quarters.
March 21 data is basically the 9-month ended FY21, minus the whole year revenue. But I believe that Q4 is always the strongest quarter for the company, and Q1 is always the slowest quarter because we are ending the year and we are beginning the year at Q1. So all budgets and everything are being consumed in Q4, and Q1 is when new business strategies are being formed. But I believe that we don't look at business from a quarter by quarter basis on Q2 and Q3. We look at more between Q3 of this year and Q3 of the previous year, because Q3 especially in West Bengal is a large festival year. We have our internal festivals which carry on for 10-12 days, and by the time that ends, we have another festival which is Diwali. So a lot of, there is not continuity of business, and we lose about 2.5-3 weeks of business out of the 12 weeks of Q3. So historically, we have seen, Q2 and Q3 to be very, very similar to each other, and we do not see Q3 being a stronger quarter than Q3 because of this presence of the festival period in Q3. So we are not too worried about the degrowth, what you see from Q2 to Q3. We are looking at more from a Q3 22 to a Q3 24 perspective.
And just to add, if you see the Q4 number of last year, that was 67 crore rupees. That was much higher in compared to Q3. So whatever we reported in Q3 this year, if we follow the same trend, then Q4 number will be better.
And probably the last year Q3 numbers were looking stronger because we came from a very muted 2 quarters because the country was almost under full lockdown. But this year we came into Q3 with a very strong Q1 and Q2. So it was not really an apple-to-apple or a like-to-like comparison.
Okay. Final question. Can you throw any color on, let's say, what sort of capacity utilization you're operating at now? Because I heard you say that there were constraints with respect to supply. Your orders were not being able to be met because of, let's say, supply side issues. So that's one. And two, while I understand you mentioned you typically take price hikes towards the starting of a new financial year. So did we see volume uptake in our international business compared to, let's say, last year? And how do you see that panning out in the future?
So I feel that it's very difficult to actually pinpoint, as I said earlier, on our capacity utilization because we are running 1,700 odd SKUs. across 55, 60 odd machines. So although 20 to 25% of the lines are dedicated, the remainder 65-70% are mixed lines which can cater to various kinds of products and various kinds of molds. So we could be back ordered in 15 to 20% of our machineries, and we could have spare capacities in the remainder part of our machineries, but the need of the hour is on the area where we are back ordered. So giving an accurate capacity utilization would not be possible because of the complexity of the same. And yes, we do change prices on an annual basis, and internationally we see a good volume growth from our existing customers, as well as constantly we are looking into newer geographies and newer territories and adding on to newer customers, as well as launching newer products in the international market. So we see a very positive trend moving in the international market. We believe that the domestic market has such a strong runway for growth that it will be tough to break this 65-35, 67-33 ratio, in the near to medium term future.
Okay. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Hardik Vora from Union Mutual Fund. Please go ahead.
Hi, good morning everyone. Good afternoon. So thank you for the opportunity and congratulations on a good 9-month performance. So first question is actually on the gross margins. I know we've already discussed on the EBITDA level discussion, but just wanted to understand one thing. If you look at the gross margins for the first 3 quarters in financial year 22, it's much higher than what we reported for the previous financial year. So just what is the reason for this improvement and why will it sustain?
So we believe that the reason for this improvement is economies of scale, as well as more value-added products which are newer products which have slightly better margins than our existing product portfolio as they take over and as they increase their share in our overall basket, as well as increase in revenue of sterilized products. So as we see today, about 25% of our revenues comes from sterile products. We are going backward integrating, building a sterilization facility, and we believe most of our new capex expansion would be sterilized products. We believe this number could go to about half of our revenue. So I think a mix of these factors have led to better gross margins from the 70-73 level, close to the higher 70s, touching 80 level.
Does that answer your question, Mr. Hardik? As there is no response from the line, we'll move to the next question, which is from the line of Jaiveer Shekhawat from Ambit Capital. Please go ahead.
Good afternoon, everyone. Mr. Sehgal, firstly on your revenue growth, would you have data on the split between the volume growth as well as the pricing growth on a YOY basis?
No, we don't. We do not have that data offhand, but we would assume that most of the revenue growth is from the volume growth, with certain price changes which were made in FY20, but not so much in FY21.
And we have a 700 SKU splitting over 300 product segments. So and the price of each product is sometimes it is 10 paisa, sometimes it is 10,000 rupees, right? So we are not tracking our revenue on a volume basis because it will not give the right picture. We are more tracking on a revenue basis.
Understood. Okay, so going ahead with the capex, I mean, could you specify how much you incurred on land for your facility in Amta, and what could be the incremental cost for setting up the sterilization facility there?
I think we have purchased a 6-acre land in Amta. I think approximately the cost was 20 crores or 200 million rupees for the purchase of the land. There would be incremental costs to set up infrastructure, which is building and other utilities.
And what would be the quantum?
The quantum would be on our entire land and on our entire infrastructure in both Panchla plus Amta would be close to about 150 to 160 crore rupees.
Understood. And if I can squeeze one more question, I wanted to understand about the OPEX, especially that they have been on an elevated level over the last 2 quarters. I mean, what's the reason behind it? I think you alluded to it, but wanted some more granularity on that.
Could you just repeat your question, please?
So we see that the OPEX have remained, the other expenses have remained at an elevated level over the last 2 quarters. So what's the exact reason behind those? So roughly touching almost about 14 crores in 2Q as well as in 3Q.
So I think I explained earlier as well that there has been an increase in packaging costs, and paper has drastically increased in price. And we are packaging intensive, so we require a lot of packaging for our products, especially high quality packaging, which adheres to international standards for our domestic and international customers. So that's played a role on our, there's been a cost pressure on the packaging side, as well as there has been a cost pressure on the employee salary side, because as you see, we have a very elaborate expansion and capex plan for the next, 18 months. So we are trying to build teams ahead of time, which will be able to execute these capex plans in the right manner, as well as build in-house R&D facilities, which we started for the first time in FY20 and have been building up our R&D and research and development facilities. So I believe that over the next few quarters, these costs will start drying up and will be absorbed as our revenues and scale grows up. So whenever we start, when we will start Amta, when we will start Panchla, the cost ratio of the people to the that place will take a few quarters to absorb, because it is a new facility which we are starting up and would not have the efficiencies what our current facilities will have. So since we are planning such a large capex plan, we would need to invest a little ahead in time, and that is why we see pressure in the salary side, and the reason we see pressures in the packaging side is because of the pricing costs of paper, and the reason we see pressures in the transportation side is because it is known that transportation and freight is at an all-time high. These are all factors which are industry-related factors, not related to our company. We would look to address the same when we come to our next price revision, which is in the financial year FY23.
And just to add, whenever we are talking about OPEX tracking, we always recommend to do the OPEX tracking and gross margin tracking on an annual basis. Because when you do the analysis on a longer horizon, you get a right picture. For example, in Q3, our gross margin is 77.9%. In the 9-month number is 79.77%. And 79.7% is phenomenal, right? So the objective is to see the picture, because quarter to quarter has a different variation. Export sales is there, sterilized sales is there, different product require different packaging. So the longer the period you take, the better will be the analysis.
There are various factors and it gets complicated. So we are at 59.41 this quarter. If we were at 65.35 or 67.33, the picture would be much different, because the realization from domestic sales is higher than the realization from international sales. So at the same cost levels, revenue would be higher and the margins would have looked a little better than what they look today.
Understood. Yes, I was actually looking for this. Thanks a lot for that.
Thank you.
Thank you. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon, and thanks for taking my question. Just on so realization on exports is low, like you just mentioned. So that's because that's the net realization, or after taking into account the freight cost and everything, or is that the gross?
It's only on the gross level. On the EBITDA and net level, the realization on exports is identical to domestic, if not slightly, because our company has grown from about 5% domestic, 5% international business to about 30-32% international business with expanded margins over the last 7 to 8 years. So it is on a gross level, because the overhead costs of doing business internationally is a fraction of the overhead costs of doing business in India. In India, we work on the customer level. On the international business, we work on the importer level, and that is the major difference.
Right. And no, I'm just trying to understand the freight cost, and so all those costs are reflected on your P&L, right? The shipping costs.
Freight costs are borne by the customer. Freight costs are borne by the customers. Duties and custom duties and clearances are paid by the customers, but the products are priced in accordance with the competitive landscape, taking into account the freight, the customs, the clearances, as well as the importer margins.
So basically, it's a pass-through, but it'll reflect on your P&L.
Absolutely, yeah. It is basically priced to the market. Just like how we are priced to the market in India, we are priced to the market internationally. The difference is we produce in India, we sell in India, we work on the customer level. Internationally, we produce in India, we sell to an international country, and we rely completely on the importer who is importing, who is then passing it on through various channels to other distributors, sub-distributors before it reaches the customer. We have not set up shop internationally. We do not have subsidiaries and our own people on the ground like the way we have in India. So this difference in cost leads to the difference in realization.
And in our financial statement, whatever revenue we are showing, that is not including freight. Freight has been netted off with the freight cost.
Okay, but then you were saying that the other expenses are higher because of higher freight expenses.
That is domestic freight, not the international freight. We are talking about the international part at this moment.
Right. Okay, so the international freight is not reflected in your.
No, it is net of the number on the invoice, which is our price to the product, our price to the customer, either in euro or US dollars.
Got it. So the freight and taxes will not be reflected, right, for international?
Because we are not, the freight and taxes will be reflected when, for example, we have a company in Germany called Tarsons GmbH. When Tarsons is the importer in that country, then we will have to account for the freight, the clearances and duties in that country. But today, our responsibility ceases once we ship the product out of our factory. So it is the responsibility of the importer, and the importer is a separate legal entity. It is not our company. Hence, he looks into the account of freight, of customs and duties, but we must account for that in our pricing so that we are competitive in those markets and we can increase our market in those countries.
Got you. And just on an overall basis, I mean, just because there are clearly a lot of expansion plans, etc. But could you sort of indicate like what level of capacity, because you're currently running an extremely tight capacity utilization or high utilization. So for FY23 over FY22, what sort of growth can you expect with the capacity expansion?
So I think we are looking to expand capacities in certain critical products and consumables as well as reusables where we are short on capacity. We aspire to become close to a 500 crore rupee company over calendar year FY24. That is the aspiration. We are working towards it as a company to achieve the same. And I believe that, we will achieve, a pretty strong growth over the next 2-3 years to reach that number. And capacities will come into place in a phased out manner. So we should not believe that we will be out of capacities all through FY23 and only commissioning of the plant in FY24. In the middle of FY24 will the capacities come into place. Capacities are coming in a phased manner. And as we have already poured in 190 crores out of the planned 400 crore expansion, a lot of capacities have already started coming in place. So things will continuously improve till 18 months, and it will not be a one-time improve at the end of 18 months.
Got it. So, so roughly, you currently this year would be 280 to 300 crores. That will go to 500 crores in the next 2 years, right?
That is what our aspiration is by calendar year 24, yeah.
Calendar year 24?
Yeah.
Okay. And just lastly, what is the capex expected for this year and next year?
I think it would depend on the product lines and how quickly the product lines and how quickly our automation partners and tool partners and mold partners are able to prepare our products and ship it out, because the capex plan is 400 to 410 crores, which we've already explained. But globally, just like there are issues in supply chain, there are issues in various parameters such as automation, a lot of parts which are required for automation. So it moves, you pay a certain advance portion and then you pay the remainder on FAT testing. So the entire capex will be consumed in the next 18 months, what we have planned. But to give you identical numbers and to give you identical timelines as to how it will move will depend a lot on how our molds, machines and other various instruments are produced and prepared and sent by our vendors from across the world. in terms of the infrastructure, the land has already been purchased and the infrastructure would move more on a monthly installment basis till the end. So it would be about another 16 to 18 months of equal installments of the amount of money which is left to build up the infrastructure for both our facilities.
So, I mean, like, because where I'm coming from is, like you said, 190 crores has already been paid. Out of this 190 crores being paid, how much was paid till FY21 itself?
Till FY21, we paid 160 crores.
So, okay, so basically that then you were left with 240 crores to be spent this year and next year.
Yeah, out of that, we already have a 60 crore rupees that is earmarked in the for the Panchla. So remaining we will fund from our internal.
Okay, got it. Great. Thank you so much.
Thank you. The next question is from the line of Rashil from Pioneer Wealth Management. Please go ahead.
Hello. Good morning, sir. Sir, my question was that since CRO and CMO and diagnostic segment, which are more of quality conscious and, there's a stickiness of the customers and not much of price sensitive in nature. So since we have a global competitors, who might have upper hand. So like what is our strategy to increase share in that segment and how we compare against those strong global brands?
I think our numbers, based on our numbers, we are one of the leading players in India, and we have done this exercise over the last 10 to 15 years to build a very, very strong and reliable brand, which is probably one of the most accepted brands in the country. And we believe now is the opportunity for us to add to our product basket by adding new products and increasing our wallet share with customers.
So can we get that, like how much revenue comes from the CRO and CMO segment and diagnostic segment? Do we track that?
We cannot track that because we work through distribution partners and our point of sale is distributors, but we assume that diagnostics would account for about 20 to 23% of our total revenue.
And so since this, these are like more of customer stickiness and quality is the like utmost priority. So how much time it takes to convert the customer since because the process will be, like once we do it on pilot basis and there will be quality department approval and all. So how much time it takes? What is the lead time basically for those products to convert the customer?
I think for newer companies, it is a very, very long lead time because most of these companies are resistant to change. As you said, they have a very high precedence on quality, but we are an established brand into most of the large customers available in the country, and hence, as I said earlier, we are just looking to add to our wallet share with these customers. We are already an approved and reliable brand for most of these customers in diagnostics and CROs.
Okay. And sir, and just on some products, like, there will be like, where price, there, like some product might be price sensitive and some might be not price sensitive. So like, how do we balance that? Like, are there any products, where the volume growth plays out, but there is no pricing power, but, there are some like, where pricing power is there, but not much volume growth?
I think, yeah, it's a mix. And we approach the market based on the product, based on the competitive pressures of the product. And we approach on a product-by-product basis. There could be certain products where the competitive pressures are very, very high, but the volumes are there, and we act accordingly. So it's a mix of everything, and what you see as on our numbers is a culmination of high margin, middle margin, low margin products, everything put together.
And so can you name those products, which are of low margin or like, where volume growth plays a lot?
I think standard products like beakers and measuring cylinders, which are a little less critical as compared to products like PCR, liquid handling, centrifugeware. So I think the standard laboratory products and having standard applications would have a slightly lower margin as compared to a little more critical products such as PCR, liquid handling, centrifugeware, cryogenics.
Sorry to interrupt. May I request Mr. Rishil to please rejoin the queue? We have participants waiting for
Okay, sure. Thank you, sir.
Thank you.
Thank you.
The next question is from the line of Anuj Jain from ValueQuest. Please go ahead.
Hello, thank you, sir. Thanks for the opportunity. I have a couple of queries. First, out of 216 crore of revenues which we have done in first 9 months, what are the COVID-related revenues?
I believe it is towards the late single digits, as we have not experienced a lot of COVID revenue in this financial year. Most of the COVID revenue came, on the last financial year and towards the beginning or the first 2 to 3 months or the first quarter of this financial year. In the last 2 quarters, we have seen COVID revenue waning off very, very strongly, and it is more of regular revenues to regular customers.
Understood. And for these late single digit revenues, what kind of margins were there? Like were they abnormally high or low, or what kind of margins if you can share?
See, we don't have a very large spike. I don't believe we have a very large spike where there is a big difference between margins, but we could expect certain products in the PCR categories having more superior margins to standard products. But on an overall basis, I do not see much of a margin difference between COVID and non-COVID sales.
Understood. And so my second question is more from the long-term strategy. As you have touched upon that, we have the aspiration to reach around 500 crores by calendar year FY24 or calendar year 24. So,
that's right.
In next 2 to 3 years, what kind of margins we can expect at EBITDA and PAT level?
So if we look at on a gross level, see, as you said, we are a fixed cost company, and everything flows down from the gross margin level. I think we've always remained in the area of 70 to 73% gross margin, but we believe that with new product lines, new value-added products, as well as capacity expansions, and increase in our ratio of sterilized products, we believe that we can have sustainable gross level margins of mid to high 70%.
And at EBITDA level?
I think we would, as you can see, our current, EBITDA levels of about, closer to the 50% mark on the late 40s is what we, aspire to, be towards the late 40s, touching 50%.
Understood. So basically, around similar margins which we are doing, and we are expecting to clock around 500 crores in next 3 years, right?
Absolutely, because we believe that there are a lot of cost inputs which we are putting today into the company, which should actually iron out as our company grows in scale and size, and we are very confident about this.
Understood. That's all. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Vivek Gautam from GS Investment. Please go ahead.
Sir, is our business a commodity business or a branded business? Because are we able to pass on the prices because our margins, EBITDA margins, net profit margins are coming down?
Sorry to interrupt you. Mr. Vivek Gautam, your voice is not audible.
Yeah. Sir, hello. Is it better?
Yes.
Yeah. So our business, is it a branded business or is it a commodity business? Because, and are we able to pass on the price? We have the pricing power because our EBITDA margin, our net profit margins are all coming down.
I believe, I don't know whether, I'm not very sure about the question about branded or commodity business, but what I can tell you is that we are priced to the market, and we price ourselves against the very best in the market, from multinational corporations till competition from within the country. And it's a common practice in our industry to change prices or review prices on an annualized basis, and not from a month to month or a day to day or a week to week basis, because that is not what the industry trend is. So unless something drastic goes on where margins, go upside down with a 50, 60, 70% change in margin where you cannot sustain, we generally do not adhere to, moving into mid-year price changes. That is not been a norm for the company or for the industry.
The second thing is about the geographical risk our company has, because you started out from Kolkata, agreed, but it is in one corner of India, and the transportation costs, I believe, are quite high. Ours is a bulky item. So no plan, and the expansion again you're doing in West Bengal only. Doesn't that put us at a certain disadvantages, plus also the work culture with too many holidays, as you just mentioned in the third quarter? So any plans of diversification geographically?
We actually work through the standard culture all across India, which is the fixed number of holidays, which is also observed in West Bengal. We believe that our know-how and technology lies in West Bengal, and we would not like to spread that out across the country. We would like to keep that know-how and technology among our key people in West Bengal, and I don't see any reduction in margin. I think we are probably the most profitable LabTech company in the country.
And just to add one more
transportation
thing,
cost, actually I'm talking about, that is also.
Yeah, but I think transportation cost is faced by other companies as well. And in terms of margins, after paying such transportation costs from Calcutta, we turn out to be one of the most profitable companies in the country in the plastic lab sector.
And we follow a centralized approach. We have all the factory, all the warehouse in one place, so we are getting the leverage of that. And second is our freight cost is not more than 5% of our top line, so it will not make much difference to have, because, and second thing is that we are also building a sterilization plant. So you cannot have the sterilization plant in different part of the country, right? So if this business model success is on a centralized.
Sir, what little bit thing about the opportunity size, CAGR and ROE you expect in the future, sir?
So I think the opportunity size is, we've already given you what we aspire to become over the next 2.5 years by calendar year 24, a 500 crore company. I think the margins have also been told in the last question where to be and where we will work towards the margins. And we expect the ROE levels to be at similar levels to what it is currently today.
Okay, sir. Thank you.
Thank you. The next question is from the line of Nikhil Chaudhary from Quest PMS. Please go ahead.
Hello.
Mr. Nikhil, please go ahead. Your line is unmuted.
Oh, am I audible?
Yes, sir. Right now. Now you are. Please go ahead.
Yeah. Hi, sir. This is Chris PMS. So, sir, thank you for the opportunity and congrats on good 9-month numbers. Sir, I have just one question. I wanted to understand, since the proportion of our cost, the value addition in the end product of our product is quite small. So cost cannot be the factor for the customer switching to us from Thermo Fisher or Becton. So I just wanted to understand what actually triggers our entry into the customer base of the global MNC. Is it the new product or is it something else that gets us into the new customer addition? Just wanted to understand that.
So as you rightly said, the cost component is smaller, so customers are very, very sticky. So actually we've done the hard part over the last 1.5 to 2 decades. We've spent a lot of time, efforts, resources on branding, marketing ourselves, and actually building a very, very high quality, robust and reliable product which customers have trusted as their choice of supply for their research, testing and production needs. So being a preferred supplier for these product lines, we are in a very, very strong position to leverage this strength and add new products and increase our product portfolio wallet share with these customers.
Understand, sir. But I was just trying to understand more from the point of view of an inertia where the customer has, where he is already getting it from the Thermo Fisher, where he is already providing it. What actually triggers our entry into the customer, new customer addition? Like, I understand this may be the best on the price point.
I think what I'm trying to explain to you is the customers are the same. We are not trying to enter into new customers. We have the existing customers. We have to enter and get a larger wallet share with those customers. And we have launched various products over the last 10 years. And since we do not see much of a struggle to enter with newer products, when we already have strong established relationships with these customers, as long as our product is delivering the quality and the reliability and the consistency what we are promising. Since we have a brand which is well accepted, we have to just deliver the quality what we are promising. As long as we do that, we get the entry.
Understood, sir. This is very clear. That's it, sir. This is all from my side. Thank you and wish you all the best.
Thank you. Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Rohan Sehgal for closing comments.
I would like to take this opportunity to thank everyone for joining the call. We will keep updating the investor community on a regular basis for incremental updates on your company. I hope we have been able to address all your queries. For any further information, kindly get in touch with me or Strategic Growth Advisors, our investor relation advisors. Thank you once again and stay safe.
Thank you. On behalf of Investec Capital Services, that concludes this conference. Thank you for joining us, and you may now disconnect.